we're seeing the momentum when it comes to the energy markets. Give us a sense. Are we headed towards $100 a gallon, a barrel gas, oil prices, excuse me, conflating oil and gas right now, but are we heading towards $100 a barrel oil prices?
Well, Frank, I think there's a good chance that we will get higher from here. Remember that the main driver of the oil market is supply, supply, supply. We've had not only Saudi cuts now for about 12 months running. Remember, the Saudis started to cut production at around $100, $95 a barrel in September of last year. So that's right around where we are today in terms of Brent prices. Also, we've seen the Russians joining the Saudis more recently, in the last 3 months or so, cutting production as well, which in turn has triggered a rally in the price of Russian oil. And then to top that off, as you mentioned, we are having bottlenecks on the refining front because these are 100-year-old factories, essentially, that nobody wants to maintain or upkeep. They're being run down as cash cows, given the fact that there is an expectation that the electric vehicle will push fuel demand lower over the course of the next 10 years. So that's where we are today. We have refinery bottlenecks. We have Saudi and then Russia cutting production on a combined basis. And that's triggered this run-up in both crude oil, but also in the prices of transportation fuels.
All right, so Francisco, you laid out a number of macro factors that I think a lot of investors are aware of. We've already seen Brent rise by about $20 a barrel in the second half of the year. Why isn't all that priced in? Why is that still, in your mind, why does it still have the potential to move oil prices higher?
Well, Frank, the big story has been for quite some time the fact that OPEC wasn't particularly happy with the prices they were getting, but also I think what's new is Russia joining to cut production. For much of the past year, the price cap situation. The price cap scheme devised by the U.S. Treasury worked very well, incentivizing Russia to maximize volumes over price. But that's also deprived a lot of revenue to the Russian Treasury, which in turn has been struggling to pay for the war effort they have running in Ukraine. So they've changed tactic, and now they're hoping to maximize prices over volume. I think it's as simple as that. We saw it in gas last year, and now we're seeing it in oil.
All right. So last night you put out a note citing that there's basically China blues right now. In your mind, consumption in China is maybe not as high as it's supposed to be. How big of a factor will China be in the oil story for the rest of this year?
I think it's going to be a big story still. But remember, even though China is not doing well because the real estate sector is very weak, because you have a weak industry on the back of the trade war, you also have a relatively thriving services sector. You have the number of flights picking up pretty quickly in China. People are spending more money in tourism, leisure, hospitality. They're going out to restaurants. They're going out to the movies, right? So they may not be spending money in big ticket items as in the past, but they are spending money in the services sector. And then we're also seeing stimulus across a number of sectors that the government can control, like, for example, transmission lines and rail stations and that kind of thing. So China is not great, but it's not terrible when you look at demand for oil, which is really driven by services.